Hello, everybody. Today is Friday, October 7th, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly, episode 652, presented by the Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves that you may have missed across financial markets. Now, if you're brand new to this video series, if it's your first time tuning in, here's how these videos work. We break up our analysis into two parts. In part one, we look through the numbers, pick out everything that stands out, looks different, interesting, or notable. And then in part two, we jump into the charts. We take a close look at price action, lots to discuss in that specific arena this week. And we also look at those bigger picture trends and try and best position ourselves, make sense of where we are in the current market landscape. We start high level and we slowly work our way down to the price action and actionable ideas. So hopefully that sounds good to you. Let's jump into some of the takeaways from this week. Now, the start of the week, fantastic for the bull case. We had the best start to a new quarter in decades. Going back, I think almost 100 years. It was back in the 1930s or 40s, I believe, is what currently holds this record. But it was one of the best two-day starts to a quarter that we have seen in pretty much everyone's lifetime. And by the end of the week, we gave almost all of that back. So we had this very quick victory lap for the bulls that was essentially pulled out from underneath them come the close on Friday. Lots of more to talk about on that later in this video. Stock indices, they're threatening to lose a big level. This is a huge level, both psychologically and just systematically and structurally in the market. These June lows matter here, and we are going to be talking a lot about that in the second half of this video. We had a 15% up week for crude oil, so certainly no joke there. There was something moving to the upside. It was crude oil. We've got bullish seasonality, which should be kicking in right now. It's actually kind of a multi-layered seasonal pattern here on multiple time frames, essentially, that is all kicking in right here. And in probably any other environment, it would, really matter. In this type of environment, well, we're going to see. And we also had new weekly closing highs for interest rates. That, in a nutshell, is not good for those high growth tech names. Let's get into it. So here is the performance on the week. You might be surprised to actually see green here, but as we mentioned at the top of the video, this was a lot more green on Tuesday. Basically, we had 5, 6, 7% gains here in the indices, all pretty much taken back here. Did manage to close green. Russell 2000 was the standout. 1 month numbers, you can see almost double digits across the board, and that's how we're looking for the week. Trends overall, we've got one little green dot here. That's the Russell 2000. In fact, the 10-period simple moving average is just barely rising. It's not rising much. It's pretty flat, but it is just inching up slightly. So that gets the one green sort of checkbox there. But in the short term, in the medium term, in the long term, we've got declining simple moving averages. That is just our quick gauge to measure trend and where the path of least resistance is. If we take a look at volatility this week, it was pretty flat. So we had certainly a roller coaster of a week, right? That's what's ironic and kind of funny about looking at just the week, the end of week numbers, is they don't tell the full story. Because again, if you were to look at just the way this market closed, you'd say to yourself, oh, okay, looks like we kind of held in there. We didn't roll over, but you sort of missed the path that we rocket shipped up and then took the other side elevator back down. So when we look here at the VIX, again, pretty flat. S&P was down slightly on the week, the VIX. Nasdaq vol rose a little bit. Russell 2000 vol came down. Now, if we take a look at our trusty drawdown monitor, you can see that if we look at the cycle drawdown lows this year, we are very close to making new lows. We're essentially flirting with these levels across the board. We're about 1% off in the S&P and the Nasdaq. Russell 2000's got maybe a couple more percent to work with, but still you can see we're encroaching on these 30% declines here and threatening to make new cycle drawdown lows. Now, if we look at 52-week highs and lows, we had, basically a period at the beginning here of the week that started off slightly, I guess, less bad, let's call it, because I don't even want to say it was constructive or positive, but it was less bad to start the week, and then it sort of incrementally grew to the negative side to finish out the week. So again, just exactly what you do not want to see if you are a bull in this environment. You're looking for stabilization. We had a couple of days of it, and then it sort of got drifted to the downside. So that still is something in the negative column that we're waiting to turn or flatten, and we're going to keep an eye on that, of course, every week. Now, this chart here I pulled from Twitter. This is Willie Delwich. You can check him out right in here. That's his handle. This is his chart, and I thought it was pretty interesting and notable here because what he's tracking is the NYSE daily volume ratio. And so this is looking at up volume versus down volume. And what we can see here recently is just these flurries of records. And there's, something to be said when you get this type of volatility. It does come at potential turning points. That is one thing to keep in mind. It can also come at accelerant points, right? But it tells you that the market is really rotating hard here, and there's lots of under the hood transactions moving across the board here. There's lots of shares trading hands, but notably here we had these extreme down days in volume where basically you had 23 to 1, 13 to 1, 9 to 1 stocks all moving to the downside. And then flip a coin, and that next day or the next series of days again to start off the quarter, we had 26 to 1 reading to the upside here. That would be the highest basically since COVID, where we had that many stocks, that much buying pressure, volume coming into the market, all pushing to the upside on these stocks. That was, an impressive reading here, an impressive cluster. Of course, we know that come the end of the week, we started to flip back down to the downside. This chart only goes as far as middle of the week. So I thought that was interesting. We're going to keep an eye on this, but those extreme flows in the direction here, that positioning is pretty extreme at this current point. Now, our second chart here, I pulled from our good friend Charlie Bolello, which is really just crushing the macro analysis and sort of big picture slides. And so this here is showing us the bear markets, the number of bear markets all the way back to the 1930s. So this is all of the bear markets throughout time here. And he's defining a bear market by a 20% peak to trough decline. I know some may not agree with that definition, but that's the standard that we're using here. And we're also now just looking at the length of the bear market. And so basically, if we look at our current period right now from January 2022 to now to September, we've effectively been in a bear market now for 8 months. And so when we look down the historical list here and we ask ourselves, in prior bear markets, how long have they lasted? You can see at the bottom here that the average duration with no recession is about 12 months. The average with a recession is about 16 months. So if we do, in fact, get labeled a recession here, and this is by the NBER, and again, that's a whole nother debate whether or not that's accurate, but it will come in hindsight. You can see just the difference in the duration on average, historically speaking. So again, this is for context. I don't think you're going to go out there and trade immediately on this chart, but this is to give context to say, hey, we're 8 months in on average. We get somewhere between 12 to 16 months in these bear markets. And you can see some, of course, outliers, or just again, the tail declines here, 36 months back in 1938 to the 42. So that was a very long bear market. 31 back in 2000 to 2002 on that dot-com bust, and 22 back in the 1980s. So there are definitely some multi-year bear market durations in here. Not sure if we're going to get that, but we're at month 8. All right, so hopefully that's helpful. It's a great chart. Again, Charlie Bolello on Twitter. That's his chart, Compound Finance. Check him out. Now, if we continue forward here, we take a look at sector performance on this week. I mean, you just got one very bright green spot here, and that's energy. 13% weak, huge week for energy, good enough to put it back in the green here for 1 month. Industrials, materials also green this week, and 3-4 other sectors. So there was a handful of performers again to the upside. They did not close at their highs, but still eking out those positive gains. On the downside, real estate getting hit 4% to the downside. Utilities continue their unwind here. Take a look at the 1 month move here in utilities. This is an extreme move here. 17% rotation out of XLU. That is one for the record books, minus 1% in consumer discretionary. All right, now if we take the sectors a little bit further, we look at industries powered by our friends over at Investors Business Daily. Check them out here with this link. It's our partner link. They're a sponsor of a lot of our content. They're good partners, good sponsors, good people, and you can get these lists curated every single day. They've got a handful of them. This is their industry rankings. We finally see energy solar drop down to number 2. But it's replaced by just oil and gas on the royalty trust side. This is still very much dominated by oil and gas, banks, a couple of banks, or just really actually, I guess just this one banks in the Southeast, and then telecom in here as well, two here on telecom, but still very dominated by energy. That's what you'd expect. Again, the sector is kind of telling you what is really happening here at the more micro industry ranking. So again, if you want that, check out the link in the description of this video. Now, 10-day correlations here. Again, no real surprise. I mean, these correlations get a little bit boring in these bear markets because everything moves so close with one another. It's very much that polarizing risk on, risk off, but we're still basically seeing the strong inverse negative correlation to the dollar and equity or risk assets. It actually has weakened a smidge here in the past 10 days. It's down to about 0.66, 0.8. So that's a little bit lower. We've actually seen that is running as high as about 0.9 or so. So maybe a little bit of decoupling here, but you really got to reach for that interpretation. And if we look at 10-year yield, again, still strong negative inverse correlation as it has been. Now, if we look at Treasury yields, I mean, they were just up across the board again. We're getting close to breaking out to new highs. And the 10-year Treasury yield now, which I think most people are paying attention to, is back up to about 3.88%. Hasn't quite crossed the 4% mark yet, but we're getting awfully close. And again, this just puts a lot of pressure on stocks, generally speaking. Now, you can buy 1-year Treasury yields, or you can put yourself into a 1-year bond without a whole lot of underlying asset risk and generate a yield of 4% or so, 3.5%, 4%. So you start doing that equation of, do I want stock risk? Do I want to just earn 4% in a, again, not a risk-free, but a 1-year T-bill or Treasury? It gets pretty compelling, or you're seeing that rotation there now as people have decisions to make, because you can actually earn some decent cash and fixed income. So again, up across the board, and we're going to continue to watch that as well. Last but not least, dollar and commodity performance here. Okay, so oil at the top of the list very clearly here, 15%, massive move. Silver, 5.7% to the upside. Bitcoin, 2.5% at the time of snapshotting this. Gold was also up this week. Agriculture ETF, DBA was up 0.8%. Dollar was up, in fact. So again, we have a rising dollar, and we've got all these other commodities that were working higher as well. Copper, natural gas, both down. And I believe copper was a new add on this list going forward. All right, and that'll do it. That'll recap our free version of Stock Market Weekly. But if you do want to continue on, if you want to continue the second half here, you can purchase the full-length episode for $5 at thetraderist.com/SMW, or you can subscribe to our monthly membership. $15 a month gets you access to all of our long-form content. We're going to spend some time looking at price action analysis, where we are, where we've come from here, and some trade opportunities or some setups, or how to just basically think about where we are in this market and manage that risk. So if that's interesting to you, then definitely check it out here. Would love to have you as a full-length subscriber. And if not, that's totally fine. Hope you enjoyed the free version. Have a great weekend, and we'll see you back here next week.